Hello, everybody. Thank you for your time this evening. Let me quickly start and give you the big picture philosophy that we have and what we have done in our offshore fund in terms of using that strategy. And then Dinshaw will explain how we have done it in our Indian PMS. But let me give you the big picture, longer term story. I will take about 45 minutes and then I'll hand it over to Dinshaw. So big picture is that, since I used to work in Alliance Capital, and it is very rare to work in a large company and to be able to develop your own philosophy, because the normal strategy in a large company is that you have a large number of fund managers and a large number of analysts. And the fund manager is basically a client of the analysts that are working inside the firm. But you can't really, beyond that, influence the process too much. Why it was possible for me to start from nearly scratch a new philosophy and actually very different from what you may see in the industry is because I moved to India. And at that time, my bosses were actually business guys rather than fund management guys. So I was left on my own and I have developed something which I will share with you. The bottom line is it's worked well and I will show you some of that. But some parts of it we think are unique to now Helios and for the last many years of Alliance while it was being developed. So before I start on the philosophy, I read this quote today in Vetri, who's from UTI, a quote on his tweet, which says, however beautiful the strategy, you should occasionally look at the results. So I thought maybe we should also start like that and first show you the results of the strategy and then we'll discuss the strategy. So this is the performance of all the India dedicated broad funds that I have managed at Alliance and at Helios. The bottom row is of the Alliance funds. The first fund on the left was actually a balanced fund with 60% equity, 40% debt. So maybe should not be compared with MSCI. And out of sheer laziness, we are comparing everything with MSCI. In the olden golden days, we used to compare it with the BSE 200. But those things are immaterial if you see the difference in our performance versus these benchmarks. The top funds are the Alliance funds, and the fund on the left is a long-short fund, which has a 60% net exposure. And that fund performance is in dollars. On the next page, I will show that you in rupees, because the fact that rupee itself depreciates 3-4% per annum also reduces the extent of outperformance when measured in dollars. The second fund in the middle is the one that we were advisors to ICICI Pru for 9 years. And effectively, it was at that time the long side of our long short fund. And broadly speaking, because we are all working towards one big portfolio, which is the long short fund, the Indian PMS is basically the long side of that. But Dinshaw Rani and we all work together, and Dinshaw is the fund manager for that, so he will explain that separately. Then on the right, we had our own long-only offshore fund, which beat the market by only 115% in that period. But then because it had one large investor who redeemed, we shut it down and thinking that we will wait, we should have continued with it, but for whatever reason, we shut it out at that time. So here, just to dramatize the performance, what we've done is taken as if I had one long track record rather than an Alliance track record and a Helios track record. And what we've done, because we are talking and comparing our benchmark in rupees, on the left, we have converted the dollar performance to rupee performance. There is no other change that has been done. And for the period between Alliance and Helios, which is this period on the left bottom, July 2003 to July 2005, we have assumed that I had the same performance as the index. I will show you one more slide, and after that we'll go into the strategy, that what was the actual performance of Alliance during that time. But for the moment, please take it that, okay, I was able to manage having the same performance as the index during the time that I was neither at Alliance nor at Helios. Then if I look at it like that, and everything else is actual, there is no back testing, there is no story that I bought Asian Paints in 2018, but if I had bought it in 96, this would have been my performance kind of logic. Then during this time, the market is up 23 times. And my performance of actually two funds, where one fund is actually a long short fund, which would have been better if it was a long only fund, because during this time the market is up 636%, which you can see on the left. The long short fund would do obviously a little worse than a long only fund, but it is such a big difference that we didn't bother to break our long short performance into what we would think was our long side performance. Then our NAV is up 335 times, which is 25.8% per annum. I saw a presentation by my friend Ramdev Agarwal on how he had personally gone from whatever crore, 1 crore to 1,400 crore. So I thought, let me also see what it would have been if this strategy was followed by anybody on a prop basis. Because this has 2% per annum kind of expense ratio, mostly a little higher than that, because the fee itself, at least in the Helios days, is 2% rack rate. That if I was to add 2 over 12 to each month, because it's on a monthly basis that we are calculating our NAV in the Helios fund, and then just put 2%. I don't remember exactly what was the expense ratio in the Alliance days, but it must have been 2 or more. Then suddenly the performance of the strategy, which means how much we've been able to extract from the market, is 539 times. This is after assuming that in the Alliance to Helios, 2 year in between, I got at least the same performance as the index. And this is just to show you more the power of the strategy, because the strategy is so simple that it will boggle your mind and you will say, how can it be? So that is why we just want to first drill it in. So in the Alliance fund, after we left Alliance, because Dinshaw and I left more or less together to actually start our own mutual fund at that time, it never worked out. So for the next 2 years, the Alliance funds again beat the market by a handsome this thing, at which point there was really one fund manager stroke analyst. The stocks had already been bought. We don't know whether he kept them or didn't keep them. But on the day we left them, these were some of the bigger positions. And the returns on the side were some of the returns that he would have got if he had kept it for those 2 years. But he must have kept them because the fund still outperformed. So that has been the extent of outperformance of this very simple strategy, which I'll come to very soon. But just to put these numbers in perspective, because there are many questions also that very few stocks do well, that all the wealth is created by 20 companies and all these kind of things, which confuse people because of Warren Buffett, who says by 10 companies and 12 companies. I just want to give you a scale of what has happened since 1996 March to last month end. And how we've done this is we've taken the current NSE 500 and seen the performance of those companies, whichever companies were there as of March 31st, 1996. So there are 32 companies that are up more than 500x. And our performance pre-fee is 539x. There are 45 companies which include those 32 companies that are up 300x during this time. There are 62 companies which include those 45 companies which are up 200x. And there are 79 companies that are up 150 times. And there are 92 companies that are up 100 times. So this idea that we should have only 5 companies in our portfolio because only 10 companies do well. Well, here is live data of, and let me tell you an interesting thing, that the number one company over this period is not Infosys. It is actually Havells. Infosys is only the third best performing stock in the last 25 years and plus 3 months. And MSCI India is up 23x. So conclusion is large number of companies do well. This I am slipping it in here because this is a key part of our philosophy. So, but the question is how to choose the companies ahead of time. It is not straightforward that I will now farm a philosophy because I will buy good companies, I'll buy this company, because everything has to be done ahead of time. It has to be done when it is not clear whether they are good companies or not. So let me give you some issues that we have seen in our life. So for example, in 1999, I got these reports from Motilal Oswal, friend, that in March 1999, they had a report on Nestle. And on Jan, 21 of the same year, written by the same guy, actually, I know the fellow now, Ayaz Mutiwala, he wrote both these reports. And these were the numbers I've just picked up from the report. On that day, how would you have chosen between Levers and Nestle, for example? What I'm trying to explain here is that in hindsight, everything looks easy. And I'll show you from 3 or 4 angles that you have to first understand that before you come to the philosophy and then accept it. So here, if you see, in 99, because I found reports from 99, I wanted them from 96. But if you looked at from 99, the ROC, the ROE, and a nearly similar P, everything was in favor of levers. But from that day to today, levers has underperformed Nifty, and it also underperformed for the next 5 years. So in 99, if you had used the numbers that were available in 99, you would have bought levers and that you would have underperformed, even though its ROC was 65% and ROE was 50%. This is another story because this is also one of our big hits. So in the year 2008, Professor Sanjay Bakshi wrote a report, which is actually available on the net and you can check it out, recommending a buy on iShares, saying that the price is 200 and that you'll get an open offer, something of 74 rupees back. And therefore, it's very cheap. And the stock actually tripled by December of 2009. And sort of this trade was over. How would you have held iShares beyond that if you were in real life? But iShares actually went up 35 times over the following 7 years, starting from December 31, 2009, after being up 300% because of, I mean, not because of, I don't know, but these events would have maybe led to it of open offer and whatever cash it had and all that. But let's look at it differently, because in this period, it's now easy for us to say we should buy private sector banks and we should buy consumer companies. But what happened in real life? Aditya Puri, in an interview to Economic Times very recently, after his retirement, said this, that when we came and started, people were laughing at us. I couldn't show the people that we were having doubts. And so my wife said, whatever, you can read it yourself. But the point being, nothing has been straightforward, and it will not be straightforward when we move on in life. Another thing that people talk about is that, oh, Kotak Bank has been a massive wealth creator. And I saw that in the wealth management study, how it is up like 500 times since 1996. The problem is it was not a bank in 96. It was a bank only as of Feb 2003. So how would you buy it ahead of that if you were to insist every time that I only buy highest quality and I only buy history and I only buy whatever? And then this is another favorite because we have been involved with this stock also, and I'll show you some of those trades. But Satyam Computer, a few months, I think 4 months before it blew up for corporate governance, actually won the Excellence in Corporate Governance Award in 2008. And the events of Satyam blowing up happened in January of 2009. And what about this? Because people say that it is easy to buy stocks and hold them, and they are compounders, and you hold them for 25 years. The reality is that the mess that you see in the market, it is not easy to do any of those things. We have seen we means the whole world who has been around for 25 years, have seen Asian crisis and Russian crisis and global financial crisis and 9/11 and sanctions on India because of nuclear tests or Kargil or terrorist attack. So it is not straightforward to see and say, we buy these stocks and we'll hold them for 25 years. First, you will not know which stocks to hold and nobody will know. Second, you will hold them and then something will happen on the stock or something will happen on the outside the stocks, but in the market or in the country, which will shake you. And all these things have to be sort of not understood, but incorporated in some sense as to how to make a philosophy. Because the general philosophy of the world, according to me, has been that we'll buy 10, 20, 50, whatever number of stocks, and we will hold them and we'll see how it goes kind of thing. And then this is another one, that let us say we look at our fund started on 15 July, this new Helios fund started in 15 July 2005. And over this period, HDFC Bank has been up 22% per annum, ICICI Bank up 15% per annum. So it looks very good that HDFC Bank has been one of our top holdings, and see how smart we are. And HDFC Bank has outperformed, say, ICICI Bank over this period. But we have investors coming in and going out every month, actually, in theory, but let's say every year. And we can't tell somebody who came in 2018 into our fund telling them today that, see, we own HDFC Bank, because from the day he's come into our fund, let's say more or less, HDFC Bank is up 9.6% per annum and ICICI Bank is up 36% per annum. And similarly, I just randomly taken these, but over the last 2 years, Nifty is up some 23% per annum and India Mart is up 213% per annum and Dixon is up 120% per annum. We have to include all these things. We are sort of an open-ended fund, or a PMS is like that, or even an AIF is more or less like that. People are coming in and going out. They may have a 2-3 year horizon. If I say I have seen over the last 10 years outperformed for you, that guy says not for me. For other people who were invested from that day, I have come in only in the last 3 years or in the last 2 years or whatever. That is what makes this job difficult for fund management. So for an individual, sometimes he may say that I have bought this stock and I will let it run for as long as it runs. And then I will see, maybe I'll sell it on the way down or whatever. But for a fund, it is not easy to do that because there are different people coming in with different horizons and who have stayed for some time and who may stay for some more time, and some who think that they've already done well and therefore they may accept more, they may tolerate some phase of underperformance and things like that. So that is now I will, with this background, tell you our philosophy and how it has worked. So as I just want to say, because I say this one every time, these are all our guesses. This is all our way of thinking. It is not the final way. Our business is such that we can't be super rigorous in terms of saying this is it and we will not deviate 1%. But broadly speaking, 95% of the time, it will be literally this, and 5%, if the team thinks something else has to be done, that will be done. So in terms of building a portfolio, we think that there are 4 pillars that are needed, and that the world concentrates mostly on only the first one, which is which stocks to buy. It is important to tell the analyst what is the time horizon over which they should analyze these stocks. Are they to look at stocks with a 10-year and a 20-year view? If we are trying to find some compounding stocks, are we to say this stock has to be a buy and hold and buy and forget for 10 years? These things have to be understood and explained. The other one is how many stocks to own at a time. If we all blindly follow what Mr. Buffett said, I will show you his numbers in terms of how many stocks he has held. But the general assumption is that he said buy 5 stocks, 10 stocks, which actually is completely wrong, but I will explain. And so there has to be some thought behind the point of how many stocks will somebody own, and then also when to sell. So what stocks to buy? We are very clear that it is not easy to know what stocks to buy. It is much easier to say what not to buy. Just like in life, it is not easy to say what to do. It is easier to first say what not to do. And then with whatever is left, you choose whatever can be best achieved in whatever is fair. So our thinking was, this has been going on for 15 years of Helios and maybe the last 3-4 years of Alliance, is that what are the things that are associated with a good company or a good stock, I should say. It should have a good theme. It should be from a favorable industry, or at least the industry should not be super competitive or super exposed to global factors or super exposed to government policies or changes in government policy. Then we recently added this potential for disruption, which previously was part of the industry in a sort of small way. And whatever strong history, governance, accounting, etc., all these are clear things. The problem in real life, other than in some random period like March 2020 and November 2008, is that all these things don't come together in one package. You will not get a very good management, good history, good growth, and suddenly say very reasonable valuations. Or you will, what we call medium-term positive triggers is actually good financial results, good next 2-3 year kind of results, or any other events associated with that company. So generally the point is that these things, it looks all good on paper that we try and buy all these things in a stock, because these things are not happening together. So the way for us to think about this is that we use these things as veto factor. We are trying at the first level to say that if the stock valuations are very high, which I'll explain later what we mean, but if they are very high, we are not bothered whether the management is good or not. If the theme is very bad, we are really not bothered how cheap the stock is. So at first level, we are trying to say that on any of these factors, if it is really bad or really high in terms of valuations, we will use veto and reject the stock for that moment till some things become better or it underperforms or whatever. But the real research comes in trying to make these trade-offs, because sometimes it will be that the management history is okay, but valuations are therefore good. And that is where the game is. There is no all or none kind of game. But if we can remove on these factors some extreme stocks, and we have been able to, from our universe of what Dinshaw will explain, from 500 stocks, we are able to remove something like 280 stocks only on the basis of effectively a veto. And then our universe is left. We are very confident that the balance 220 stocks with themselves significantly outperform the markets. And that is why we feel comfortable when we are buying, because we have at least thrown out whatever we could think are bad things. Other thing we've realized over the years is that because it is difficult to know what is good, that is why we are saying we are starting with the bad, and that there is real value in differentiating between good and bad. And there is not much value in trying to choose between one good company and another good company, particularly if they're in different sectors, only for the reason that, oh, I can't have one extra stock because God knows what will happen. If instead of 25 stocks, I have 27 stocks. If we can't differentiate, if they look okay, it's okay to buy both. And we were very happy because this has been going on for so long, to see Nassim Taleb saying in Skin in the Game that acting by removing, because he uses more colorful words than me, via negativa or acting by removing is more powerful and less error prone than via positiva. Quickly, just one more thing on this, because I've been saying on Twitter that you should not just ask why you think like this, because he will give some logic. You should say, how do you know that what you are saying is right? And I found this much later. Actually, I found this during the COVID times. This is a study which came out in April 2020. I saw it in Bloomberg, so I read the paper. You can download it yourself. Basically, what they're saying is that they analyzed 1,489 hedge funds. And I think they got the data from some prime brokers, and they saw that these funds had outperformed the benchmark by 2.5% per annum on their domestic, which means I guess the US market. But the top stocks or the best ideas of these funds did not outperform their own fund, which I have interpreted to say that we can differentiate between good and bad, but between the good, which one is better, which one is worse, well, at least none of these guys could figure out. And you could say that even for us. So, for example, for this year, our second highest position is HDFC Bank, and it has massively outperformed our own performance and also outperformed the market, I think. So it is very much over analysis and unreasonable this thing to say that I will first find good stocks, which many people may say, but then I will drill it down so much that I will then have 5 stocks or 10 stocks. If you look at the performance of Amazon for the last 12 months, the market in the US is up some 35%. Amazon, I think, is down, and Google is up some 70%. Now, how are you supposed to figure that out, that this year is Google's turn and not Apple's turn? Just like in India, how would you think in December 2020 that 21 will be State Bank of India's turn, which is up some 60%, while Kotak Bank is maybe down 5%, or HDFC Bank, which is up some 9-10%. So therefore, we say differentiate between good and bad, and then pray hard. Quickly, the themes. See the time. Okay, so the themes basically, which is our first screen, we like 3 big picture themes. I have already spoken about it a lot in the past, so I won't discuss here. But our first theme, which we discovered in the 90s, was that because seeing our own alliance compete with UTI, that companies which are competing with government companies will do well, and that is how we made so much money in Z and Bharti and HDFC Bank and all that. And we still like that theme. It, in practical terms, is basically private sector financials these days. The second theme that we liked all our life, working life, is that we don't have a 1.3 billion consumers. We really want to see whether there is under penetration in the 300-400 million middle class. Because if you divide by 1.3 billion, then everything looks under penetrated. And I believe that The real way to imagine whether it happens or not, long-term growth, is if that company or that sector, it can be defined or can be viewed as being under-penetrated. So that's why we call them non-zero sum theme, where everybody can grow together and you're not really fighting with each other. So in the first theme, all the private sector guys were sort of fighting with the government-owned companies, and they were taking market share. The second one, you are so under-penetrated even in the urban India or the middle class India that all of them can grow because the pie will grow at a good rate, and then more people will keep joining. And the third theme that we like, because we are a product of the 90s, we have seen software industry develop in front of us. And so we always liked it. And over time, we wanted to see other sectors that look like software. And so then we went into pharma, and for the last 4-5 years in specialty chemicals, because basically they are sort of similar in some sense, that they are export and there's an India advantage, and that China is either not competing or doesn't want to compete or is giving up, like it did with specialty chemicals, a little bit of space for the Indian guys to take over. But because we are practical guys, because we ourselves are the largest investors in the offshore fund, we are not dumb people that, oh, we like these three themes, we have announced it on our webinar, so now that is it. Because we have realized in real life there'll be things that will be happening for long periods, 2, 3, 4-year periods, and we can't say we only analyze this. So we basically say upfront that broadly speaking, this is what we like, but 10-15% of our fund may be in stocks that don't fit the theme. Today we have State Bank of India for a long time, and in Shaw will talk, we have Tata Steel and we have Bharti, which we don't say is one of these things. Bharti, we could have fitted somewhere if we really wanted to. But generally, from our point of view, they are not part of our these three big picture themes, but we have them, and I think total is around 12%. So as we say, these are the things we don't like. We don't like commodities, but we own Tata Steel. We don't like 1 billion consumer stories, and currently we don't have any 1 billion consumer stories. We don't like state-owned companies, but we have State Bank. And we don't like Tata Motor type companies, and we don't have those kind of companies. We want a company which is a play on India, not just something owned by Indians. Quickly. So these are our various checklists. As I said, the idea is at this level is to reject. Sometimes the rejection is outright, and sometimes it is confusing because there are trade-offs between slightly off kind of thing or a little bit bad, but broadly then you have to use your experience for that. So the big picture here is that out of these 6 factors, out of these 8 factors, these are 7 and the theme was the 8th, that 6 factors are longer term. That means the theme doesn't change every day, the history doesn't change every day, the accounting doesn't change or whatever doesn't change. What really changes on a day-to-day basis is medium-term triggers, which we are calling results or anything else related to next 2-3 years, or valuation or price, that means. So every day, it's not that every day for every stock, suddenly you start looking at 8 factors and saying, oh my God, what happens? Because the 6 factors, based on the experience of Dinshaw, me and Abhay and Alok, we have already broadly classified into stocks that we would buy, and which are willing to buy and which we are not willing to buy. And then we are really looking at medium-term triggers and valuation to decide whether to buy or not. But as we will show you, we are not doing this for trades. This we are doing for buying and then at least keeping for a decent 50-100% kind gain. We are not trying to buy stocks for a 5-10% trigger. So then the next question is how many stocks to own at a time. I will do it quickly. I already showed you that 90 stocks have gone up more than 100x in the last 25 years. But it is very logical that a large number of companies do well, simply because there are a large number of companies in the market. And it is almost by definition that if our objective is to beat the index will be beaten by a large number of companies. Simply, there are 500 companies in the market, and you're trying to beat an average which will lie somewhere in the 230, 240 range, then you could have bought any of the 230 companies and you would have beaten the index. So here, if you look at it quickly, at just the 150th best stock each year, you would have been up in the US 19.3 times, while the market is up 4.3 times. And therefore, every year, You have a choice of 150 or even 200 companies. If you buy any of them or all of them, you will massively beat the market. This is just the performance of the 150th stock. If you bought two stocks in which one was 150th and one by your good luck was the 70th best, you will be much, much higher than the index. So give up this idea that very few companies do well. The how, I've explained why, how it is explained like that. But here you can see that if you hold a stock for 3 years, in this assumption, we were assuming that you're changing the stock every year, which people may say, how can it be and how will I change and all that. So let's look at it over 3 years, which is a reasonable holding period for anybody. Then a stock which may have done well in 1 year may do less well in the other, or may fall a little as it consolidates, blah, blah, blah. But still, there are at least 150 stocks which are massively beating the market, and 200 stocks which are a little bit ahead of the market. It is just to do with numbers. Look at it for India, which is a super volatile market. And therefore, suddenly you'll have a stock like Dixon go up 300-400%. And nobody would have imagined at the beginning of the year that this stock is supposed to go up 300% this year. And next year, some other stock will go up, like SRF will suddenly go up a few 100% without anybody feeling how suddenly what happened for them to go up so much. But that is how the market is. And you are never, ever going to get it correct if you think that you have chosen two stocks and they will go up. So here, if you look at the 90th best stock, here we are not even talking of NSE 500 and therefore the 150th stock and all that, because NSE 500, maybe the 480th stock is too small. So let's look at only the last 300 stocks at the beginning of each year. And if you had only any of the 90 stocks, you would have been up more than 57 times, while the market is up 8 times. And similarly, you can have a longer holding period. You can have, we have done it, you can have a 15-year holding period. Anyway, we showed you live that for a 25-year holding period, you had 90 stocks which were up 100 times. Let's take it at that time, maybe there were 500-700 stocks which were there, any reasonable, maybe 1,000. Even then, a large number of stocks are doing well. So now the next question is a time horizon, which is what I was saying. So we say that long-term is a series of 1 to 3 years short-term. We are not objecting to the idea that many stocks compound for long periods of time. We have had many, in fact, as you saw, our fund is like a better compounder than half of these stocks or most of these stocks. But for even a bank, HDFC Bank, Kotak Bank, which we held for many years, we are never looking at them as 10-year stories. We are looking at every story as a 1 to 3 year story. If it works there, it deserves another 1 to 3 years. If it doesn't, it's out. That is the way it is. It is not, because you never know in advance whose turn it is next, which management will do so differently. We bought Bajaj Finance in some 2011. Neither the management nor the owner, Mr. Bajaj, nor Sabir Arora, knew that this is going to be a rock star kind of a company. You buy it thinking it's okay for the next 1 to 3 years based on whatever is the story there. And then you analyze as you hold it. So that is our story. We are not looking at 10-year and 20-year story. Although we, because having been around for 25 years, may have held many stocks longer than anybody else because those people were not born since we started buying. So here is my favorite example, that after owning HDFC Bank for 26 years, by the way, there's one mistake here. It says it has been his number one holding all along. No, it has been in the top 10 holdings all along. But we are not long-term investors in HDFC Bank. We have never been. We have just held it for 26 years. And that is what I want to talk about. That if every year, my analyst and me, and sometimes Dinshaw also, because for this Abhay is the analyst, every time HDFC Bank call is going on, we are there. Every time HDFC management wants to do a meeting, investor meeting, we are there, or we want to be there. Or we say, if you're coming to Singapore, please meet us. How are we long-term investors? We are analyzing it literally every day. And because it has continued to do well, we have continued to hold it. That is not long-term, according to me. The long-term would be, I'm not interested in knowing what you are doing. I have bought your stock. I believe you. Have a nice day. I'm going on my cruise. We are literally taking it as a month-to-month or a quarter-to-quarter or year-to-year kind of a thing. If the company was to say that we are in deep trouble, we have negative results for 2 years, but we have done well in the past with us. Please hold on. Will we? We don't know, but mostly no. So this is not long-term investing. What people think that I bought this stock, and because the stock continued to do well, you continue to hold it. Sometimes the price may not go up, like it didn't go up for me in 98 to 2000 for 3.5 years. And I held it because the company was doing well. That is a different game. That if you want to call that long-term, yes, we may be long-term. Even now we've been holding it for 3 extra years. It hasn't really done much for us. But the point is, it is just easy to say that you buy a stock and you become long-term. Long-term is in the mind. And in our mind, we are 1 to 3 year investors. So how many stocks to own at a time? So our logic here is that you have to be the casino and not the gambler, because as we know, the casino always wins and we want to be the casino. So what that means is that when you are, if we have a small advantage over the market because we are analyzing the things, we have some 8 factors, we have some experienced team. Therefore, if the market is just the market and we have a small systematic advantage over the market because we did not buy bad company or we did not buy an expensive company, that small advantage can only be converted into consistent returns if we put more bets on the table. If our bets on the table are 5 or 10, it is easily possible that luck overwhelms it, just like you can go to a casino and win in roulette or win in some other game where the actual statistical advantage is with the casino, but you may still win once in a while. But you play every day and you play 10 times a day, you're not going to win. So we want to put more bets on the table. And we say we want 2 kinds of stocks. Portfolio has to have 2 kinds of stocks. One is high confidence in reasonable return. These are stocks which have done well over the years, like maybe HDFC Bank or Kotak Bank or TCS or Infosys or whatever, which you've chosen from a universe of the large names, well-known names. And here at best, we are expecting the earnings to be delivered to us in form of stock appreciation. But we really are not thinking that these stocks have to be re-rated. If these stocks get re-rated and we are owning them, we will enjoy them in the beginning and then we will trim them. And then one day we'll say it is not possible and we will sell it and not come back till the valuations come back. But it is not that on day one we will sell them and say, okay, I had a limit of 40 valuation of PE or whatever, and therefore I'm out. But broadly, you will feel uncomfortable because the stock was already well known. The second group is a group of stocks where again those 8 factors were in favor and 1 or 2 factors were seriously positively in favor, but there's something new. There is something different because the history is not long, or the stocks have been doing badly in the past, or it is something like State Bank of India, which you've never owned in the past. So you will start with a smaller position. We want to buy 2% kind positions, maybe 15 stocks, maybe 20 stocks, 40, 50%. And if they go up, you'll be happy to buy more. But we are never, ever going to have a category which says high confidence in high returns. We are just that we may feel in our heart for some stocks, but our categories are these 2. So quickly on Mr. Buffett, because I found later that for whatever reasons, he's been doing similar things in some areas. So here he says, this is from this Morgan Housel. He writes letters every day, more or less, I think, and you can read it there. He says he's owned 400 to 500 stocks during his life, but made his money only on 10 of them. If you look at Rakesh Jhunjhunwala, he's made his money, serious money, on maybe 8 stocks, 10 stocks, 15 stocks. But he would have also bought, as you know, hundreds of stocks. That is just the way it is. You will buy more stocks. Some will break even. Some will do in line with the market and some will massively outperform. But you are not really exactly going to know whose turn it is next. And here is Mr. Buffett's own track record. If he says that only 10 of his 400 stocks ever, my track record in percentage wise like this might be a little better, but that is the reality of this business. And here is another one on how, so this is from a paper, an academic paper written by these 3 guys. You can download that on the net. And they analyzed his 26 years of quarterly disclosures. And they are saying they found 2,140 whatever observations, and then 275 of which he had got some approval to delay the disclosure. And the median holding period he had was 1 year. and 20% of stocks held for more than 2 years, and 30% were sold within 6 months. I am not saying it. This is an academic paper. Please go and look for it. But that is the correct thing, that you are not exactly going to know for sure what happens. You will buy. It'll give you some confidence. In fact, if you own the stock and it does well, it is easier for you to add more because you still think it's your stock. And even though you had 1.5% or 2%, you can add to it because it was your stock. But if you have not owned it and you are waiting for more confirmation and then the stock does well without you, it is very difficult for you to start a position after the stock is up, say 50, 100%, because you will say, I've been analyzing it from that price. How can I buy it now? But if you have it, it is easier to add. So I'll give you some examples from that logic where we have in these stocks bought only 2-3% in the starting. We have never really added after that, but these stocks have been such rockets, and that you can see that the performance that I showed you. So here it is. We bought Eicher Motor in 2009 September, and finally we sold because we never really bought any extra. Red means we sold. This is from our offshore fund. We finally sold it because of demon and then never bought it again. In November 2016, by that time, the stock was up, 50 times for us. Not for the whole position, because we keep selling along the way, because that is how we are. We will not let a stock go more than 4, 5, 6%. And if it's really good, maybe it becomes 7, but broadly, it'll go to 6, 7, and that it can do in its first move. So here, see Bajaj Finance. We bought it at a price of 60 rupees in July of 2011 to December 11. Average price was 66. And then we sold a little bit, bought a little bit, but finally we sold everything again because of demon, because we were very negative on demon, at a price of 876 only. So from 60 to 876, 10, 12 times. But then I realized that the demon view was wrong because the market was not bothered, even though the economy till today is suffering. So you see here, we bought exactly the same quantity back, 100 rupees higher at 961. Or a little less than 100 rupees higher. We sold everything at 876, bought the same quantity just so that we don't feel bad that we bought less or more. And we bought it at 961. Then and again, we sold it over time, mostly last year. And this is the one which I was telling about, ICICI Bank, which today is actually our number 1 holding, and HDFC Bank has become number 2. But we bought it but we did not buy 10% on that day, and we did not buy 5% on that day. The whole point is we bought maybe 3% of ICICI Bank, but definitely for Bajaj Finance and Eicher, it was in the 2s when we bought it. And this idea that how can a stock, if you know it is going up, how can you buy 2% is so illogical, because nobody knows that it will go up so much. You are buying it thinking it's good, and then as it goes up, you may add if you want. But broadly, we've never felt the need to add. And just I want to give you some more interesting things before I hand it to Dinshaw, that because we also short stocks, not directly applicable to our PMS business, but because of that, we analyze more and we are more into the market and do everything. And this, we basically kept shorting because it kept falling, and we were able to bring it back to our 2.5% size of the short that we do. And this one I wanted to show you that we even shorted Satyam before it happened, when after the independent directors resigned. So the point is that the two factors, the valuation and the trigger, is the real work. Rest is longer term, and people are deliberately inflating the job to say we look at corporate governance. What are you supposed to look at corporate governance? You looked at it every day. If some change happens, like it may happen in AU is different. But otherwise, every day corporate governance is not changing. Every day history is not changing. Every day theme is not changing. And every day respect for management and all is not changing, except when it changes once. I mean, seriously. So really on a day-to-day basis, it is medium-term triggers and valuation. And quickly on the sell, basically I've already told you that we want to make money in the first group from earnings growth. And in the second group, it depends because you are trying to buy them early or when there's a turnaround potential or whatever. And therefore, this is the only discipline we say, that we showed you that in case of Bajaj Finance or Eicher or anything, we have sold it along the way because we believe in the fact that valuations have to be somewhat reasonable. Once in a while, we also have stocks that have very high valuation, but because we are enjoying it for the moment, but we'll be the first to let it go when we find something else interesting. So this is just one more thing of how these companies change over time. That in 1990, the most admired company, very few of them you find in 2000. The companies of 2000, very few you find in 2010. The admired companies of 2010, you find very few of them in 2020, maybe 30, 40%. Look at 2010 to 20. J&J is not there, P&G is not there, Toyota is not there, Goldman Sachs is not there, Walmart is not there, Coca-Cola is not there. So what is this thing that we admire this company and we admire that company? We admire our investors. And this, of course, you can see for GE, when everybody was admiring this company, and these were the things which you would die for in terms of management, what happened to the company. So at this point, I will hand it over to Mr. Irani, who will tell you, like I've shown you some traits from my previous life, he will show you something more current. And the time is 7:25. Amazing.
Thank you, Samir. Can I? Yeah. So thank you, Samir. I will go on to how we operationalize the philosophy on a day-to-day basis. A lot has been talked about the team by Devi Prasad during his introduction, but let me just add a few more lines. 4 members of the team bring over 27 years of equity experience to the table. In fact, combined together, it's over 100 years for the team as such. 3 of these members have been working together from day one of Helios. In fact, 4 members have been operationalizing this theme on a regular basis the last 15, 16 years. And as Samir had told you earlier, that I joined him in 2000 in Alliance, and I've known this philosophy for the last 21 odd years. Now, to implement this philosophy, you need to have a deep understanding of the industry. And why a deep understanding? Because that gives you, makes you understand that delta or that change which is needed for you to change your view on the industry. And that delta could be as simple as probably the US FDA increasing its presence in India, say in the middle of last decade, which saw the pharma industry suffering for at least half a decade, and it took a pandemic to change that view. Or could be as complicated as sitting with an IT experts and trying to understand what as a service platforms or artificial intelligence or machine learning or automation would do to that industry, and who will be the winners, who will be the losers, and how will the industry respond to these kind of challenges. So these are the kind of understanding. And as you see in the slide itself, I mean, my colleague Abhay and myself have been covering certain industries for 2.5 decades. And that is what gives us the edge to understand where is the delta which is needed. So early recognition of change, as Samir said, this is what helps in early recognition of change, your understanding, in-depth understanding of the industry. Now we have these 8 factors of rejection. As highlighted to you earlier, the top 6 factors are fairly permanent and fairly non-negotiable. These are longer term in nature and will take a long while to change in a company. So whatever, if you put say NSE 500 through a sieve of these 6 factors, the top 6 factors is the size of the opportunity, industry dynamics, potential for disruption, management strength, corporate governance and accounting, you will be left with around 220 odd stocks. These 280 stocks will go to bucket 1. Now, these are all buckets that we have created in our minds. I mean, they are there in the paper, but just for you to understand how we allocate to different buckets. So bucket 1 will have these 280 odd stocks, which we will not buy. But that still doesn't mean that we will not cover them. We will be covering them regularly, because not only does they help in understanding, these stocks help in understanding our existing holdings or the potential holdings, they will also be a reservoir for our shorting in a long short term. So that helps us, that the shorting itself helps us in different ways, which we'll discuss during the Q&A. Now that's bucket 1. Bucket 4 is actually the portfolio that we are holding today. So that's your bucket 4. That will have around 30, 35 odd names in this particular bucket. Bucket 3 is a reservoir for the existing portfolio. Now this could have easily gone into our portfolio, but because of sizing issues or because of cash requirements, they're remaining there. And as and when we trim or we sell out from our portfolio, we'll be dipping into this particular bucket 3 to put into bucket 4. Bucket 2 is basically where the last two parameters are not being met, which will be the medium-term triggers and valuations. Mainly these stocks we will buy at some point in time, but not today, because either on the valuation scale, they are much beyond our comfort levels, or there are no triggers which are looking, I mean, there may be some triggers, but maybe negative triggers if all we know that. So that's why they'll remain in bucket 2 as such. So now understand this particular thing, and let's move on to the next one, which will give you the live example of how we implement this process of moving from one bucket to the other. Now, these are all the next three stocks that I'll be discussing. These are all three which are there in the portfolio today. So Laurus Labs, when the stock came about, I mean, till 2018, it was mainly a commodity play, basically because he was into ARV APIs, which are mainly a commodity play because it's an institutional bleeding process and very low margins in that business. In 19, the management started talking about changing from pure ARV API play to, say, diversifying into oncology and anti-infective APIs also, which are higher margin APIs. They also talked about getting into fixed dosage forms, which are basically the finished form of an API, that is tablet that you consume. So that made us aware that, okay, there is some change in the management and there's some understanding which is changing, and that as a result, the margins will move up. Also, the management in FY20, sometime in FY20, stated that they are looking at increasing capex, and the capex will be roughly around 2/3 of the existing gross block. So when an API player talks about a capex, which is a greenfield and a brownfield mix, we were aware that there's some line of sight that he's got on his orders, and that's why he's looking at these kind of massive expansion in capex. And finally, the trigger for it to move into our bucket 1, which is our portfolio, was the fact that the management finally, I mean, the results came out, the margins improved, the return ratios improved, China plus one strategy played out to the hilt. We said, okay, this is the time to get into it. We waited for the price to stabilize and finally got into that stock as such, and it went into our bucket number 4, which is our portfolio from number 2. The next one is Piramal. Again, sorry, let me just cover this also, that we bought it probably a year back, and despite buying it at a higher price, even today we are making around 200% in a matter of a year's time. And that's how handsome the returns have been in this particular stock. Piramal Enterprises, a wholesale lender, mainly catering to the real estate developers, that too. Nowhere in the retail book, it was mainly a wholesale player. Looked good at that point in time because the management was decent. He had made it to our bucket 2, but there were no triggers because valuation also looked expensive. But then came ILFS sometime in November of 2018, October, November 2018, and the stock took a tank. And the management also realized that to survive, they have to make certain changes in their way they're doing their business. So they looked at, they tried to balance their mismatch on the liability side. They sold off certain assets, and they started making sound bites about how they want to diversify their asset book also, which was highly skewed towards the builders. So that made us aware that, okay, the management is talking, but the change wasn't good enough for us to view that stock. By February of last year, the stock had already corrected almost 60% from its peak. And that made us very aware that, okay, the management is now looking at making things. But the real trigger for us was the serious move of the management to start unlocking value, because they also had a pharma business, which is an ODM heavy business, which is what DVs does. And by the way, according to us, their ODM business is akin to a DVs because they've never been hauled up by US FDA. There's not a single 483 which has ever been issued to them. So it's a quality pharma business which is in operation. They unlocked value there by selling 20% stake to Carlyle for 17,500 crores. 17,600 crores. So that was one. And secondly, they went and bid for the retail book for Dewan Housing, which again made us believe that, okay, the management is serious about looking at this. And that's why this made it to our portfolio, which is the bucket 4. From bucket 2, it moved into our bucket 4 per se. The third one, which is the most glaring one, because that State Bank of India, as Sameer just mentioned, we we don't buy public sector companies. This is probably the only public sector company which is today in our portfolio. And that's mainly because we always believed that State Bank is probably akin to a private sector, given the way he efficiently he's managed his books, not only on his asset side, but also on the liability side, probably the most conservative in accounting, even as compared to private sector banks. He's got his own digital platform on which he offers digital banking, which is fairly well accepted by the market. So it was akin to a private sector bank. But then again, it was in our bucket 2, but never made it to bucket 3 or 4, basically because we weren't comfortable with the price to book at that point in time. But then came along COVID, the stock corrected almost 50% because of the lockdowns in May of 2020. And that's when we said, okay, if you look at the value being provided by his listed and unlisted subsidiaries, he's one of the majors in, say, insurance or AMC business or credit card company, credit card offerings. So we said, okay, if we remove the value of these subsidiaries, the price to book for this particular, for the core bank was just 0.2 times book, which was very appealing to us. We got into that stock. It's done fairly well for us. From June that we bought, the stock is up 121. Sorry, Piramal also was up some 70% from the time we bought, which was in December of 2020. So that's on these. This is early recognition of change. But then we also realize that there is certain changes which are not that permanent also. I mean, there are, so the two stocks that we're discussing here, one of them is Indian Hotels. And we bought this stock basically because we realized that, so pre-pandemic, the stock's regular price was around 150 odd rupees. And the stock corrected because of the lockdowns and came down to 80 odd rupees. And we said, okay, this guy's a survivor. There's no way Indian Hotels will blow up because the industry is taking a prolonged time to open up. So if you want to be in the hotel stocks, this is the best play to play out. It had already corrected from very good quality management. We said, okay, let's get into this stock and let's ride out as and when the unlock happens. Probably we can see some upside in this stock, and probably in the next 2-3 years, it'll come back to its regular prices, which is 100% return over a period of 2-3 years, which is not a bad return at all. But the stock went up much before and much beyond our imagination per se. And we said, okay, the change is there, but it's not that much a change also to honor this kind of a pricing. And we realized that hotel industry will take a long time to come back to normalcy, given that the pandemic kept on continuing. So we said, okay, since we made our money, which we were expecting to make in 2 years, why not get out of the stock then? So, and we moved out, and the stock has not gone anywhere. We moved out at 118 to the stock at 140. By the way, when we moved out at 118, we would have invested in probably a Piramal, which has given us a much higher return than Indian Hotels. The next one is India Mart. Again, the trigger for buying this stock was the lockdowns, which had impacted the MSME sector. We realized for the MSME sector to survive, they had to get onto an online selling platform. And India Mart was probably the only listed player at that point in time, which was offering you that option. But unlike Amazon, which charges you a percentage of fees of the fees of the trade which goes through its website, India Mart was just going to charge a listing fee to the MSME. So there's a limit to which India Mart could have gained. It would have gained only to the amount of number of new MSMEs registering on their website, and not the trade which was passing through the website. So there was a limit to how much it could have grown. We bought the stock at we were aware of this, right? So we bought the stock at around 2,600 odd rupees. Within a couple of, 6-7 months, the stock ran up to 9,000 odd rupees. And we said, hang on, this is the kind of return we are looking at in the next 4 to 5 years, and has given this return in a matter of 8 months. So, and our analyst was still fairly keen that, there's a long-term story here playing out. And we said, okay, let's step back. Let's do a reverse DCF and understand what is the terminal growth that is needed to justify this kind of a price. And the terminal growth was in double digits. So we said, no way any industry can grow at this pace. And so we were out of this stock. And fortunately, because of it going to FNO, the stock is at 7,900, but before that it was 7,200 a couple of days back. So it's gone anywhere after we sold off. One more thing that a fund manager needs is patience, because ultimately you're trying to develop a team which is going to run a relay marathon. And here, when we say relay marathon, we mean there'll be a set of stocks which will be leaders, which may just tire out, and another set has to take over the baton from these leaders and start leading. And that's why there'll always be a set of stocks which will be in the background, which will give you stability, which will give you that strength. And that is the patience that a fund manager needs, so that when he's aware that, okay, these are the stocks which are your future leaders, which may take over at a later date. So some of the names we've shared here, fortunately, this was made at the end of July, and probably Bharti has now taken off from the blocks. So has HDFC Bank to an extent. And I think these are the two which will be the future leaders, and Bharti is already there in the lead. So that's the kind of patience which is needed, and that's why I wanted to highlight that. Ultimately, everything has to come out to some performance, right? I mean, your philosophy may be right, as somebody rightly shared with you, that proof of pudding is in what you are eating, right? In the taste of the pudding itself. So here are the three themes that we discuss in the other segment, which is beyond the themes. Now, these three themes, we could easily come out with three different offerings based on these three themes. But we said that is not being fair to our investor, because he will not be expert enough to understand which themes will work when which period of times, right? So we said, okay, let's club the themes together, give out one single offering, because these three themes are like three mini strategies. So we club the three themes together, and we, on behalf of our investor, decide on which theme will work best in which time period. And that's why we mix and match these themes. In fact, the performance that Samir shared with you in the beginning, a large part has to do with the way these three themes were played around with during certain periods of time. For instance, today, our theme 3 is what we expect to do better in the future as compared to a theme 2, which is mainly discretionary spends, which we believe have taken a small hit because of the wave 2. So that's how we are working out here. The next one is the mix as per the market caps. Here again, you'll notice that small caps has been very low today. This is today. And if you've been tracking Samir or myself on the screen, you'll realize that we've been shouting from the rooftops that small caps are looking overpriced. And that's why we're very cautious on the small cap front today. And that's why the weightage in small cap is low. So this mix also keeps changing as per our view on the market. Today, we are more comfortable with large cap valuations, and that's why the large cap plays here. Even in the small cap, the smallest of small cap that we own today is some 5,000 crores of market cap. So it's not really a small cap per se. The next slide is about the performance. Here, since SEBI has changed the reporting norms for the performance, what we try to do to you to make you understand what a real investor would have got in our thing, since SEBI wants us to invest on give out the performance on an investor pool. We've also shown you the performance of the investor who came in on day one of our portfolio. Now, the day one investor has got a return of 82% as compared to that of the index, which is at 70%. By the way, the index that we track is NSE 500, which probably is the most difficult of index to beat, because it's got 250 small caps, and these small caps can really turn the tables on you in a moving market. But despite that, we've beaten the index very handsomely. On a pool basis, you'll see the performance is more or less in line with the index. That's basically because a bulk of our money comes in the form of systematic transfer plans. Now, these STPs allow the investor to invest his money in 5 different installments. Every month, 20% of his money moves to equity. The remaining money lies in liquid funds. And that's why the overall performance is pulled down because of that liquid fund which is lying there. But since the investor who came in on day one, he 100% invested on day one in equity, and that's why his return is so different as compared to that of the pool per se. So that will be a more indicative return. Sorry, let me just put this up. Yeah. Now, this what we try to do is that show you the actual performance of the day one investor. The day one, we started our fund on 16th of March 2020. The day one investor came in on 16th of March 2020, invested 1 crore of rupees with us. Today, that crore of rupees has become 1 crore 91, 1.91. crores, and that's 91.25% kind of return. But what we want to highlight to you here is that look at the gains, how they've been spread around between realized and unrealized. The realized gains are just around 22% of the overall gains of the portfolio. And that is what we want to highlight here, that we are not trading on a regular basis. Bulk of the gains are lying in unrealized. This portfolio has been around for the last 15 months with us, over 15 months now, but still the realized gains is very minuscule. And that's what we aspire to do. Hold stocks for a longer time. The realized gains are minuscule as compared to that. And that I will end here, and I'll hand over to Devi for the Q&A. We'll stop share.
Thank you, Samir, and thank you, Dinsha, for a insightful session. So let me straightforward. We have got a lot of questions yesterday to the registration portal. Let me straightforward jump into the most common question asked these days. These days is like about the Fed tapering, that the impact of Fed tapering on Indian markets, and also in terms of our valuations, where there have been talks about our valuations being stretched, which is sort of fact, but on a forward-looking basis, what are we making out of the entire proposition? You're on mute.
So Samir, you're frozen.
Okay. I'm frozen? No. So on the Fed tapering, the thing is that we already got a output from Jackson Hole that these guys are going to slowly taper, and that they have already said themselves that tapering is not to be viewed as a view on hiking interest rates. And secondly, that hiking interest rates itself is not such a bad thing if the economy is improving, and if on every other parameter you are going back to pre-COVID times, then why interest rates in the US can't go back to at least pre-COVID times, which has been what my thinking has been, that today pre-COVID, the rates were around 1.92%. So why should we say that unemployment will go back and GDP will go back, and market obviously has already gone to higher than that. But for some reason, the interest rates have to be much lower than that. We also have evidence from 2004, or 2003 to 2007, when there were 17 consecutive hikes in the US of 0.25% in each meeting. And you can go and see that on Investopedia, all the things, that there were 17 hikes consecutively accumulating to 4.25%. And the biggest bull run we've had in our life was in 2003 to 7. The reason why tapering was viewed negatively was because in 2000, was it 11 or 13, when at that time, India was considered in the fragile five, and therefore there was a panic that money will go and all. These guys themselves now know. These guys means the Federal Reserve, that they have to carry the whole world along. And also India itself is much stronger in terms of having more than $620 billion of FX reserves. When I started, we had less than $1 billion in 91. And so I think that part is okay for now. In fact, the market has gone up because people are relieved that the taper event is over and it was never going to lead to anything significant. But still, you have to sort of go through these things. What was the second question? Valuation. So the valuation thing is that if we look at our financial sector, they are not really much differently valued than they were many years ago. If you look at the private sector banks, if you look at some even NBFCs other than Bajaj Finance types, broadly, if you look at the last 5-10-year earnings growth, the stock price performance is more or less in line with that. So if you look at history as a guide, the valuations are not very different. For the software sector, they are higher, but they are being viewed as genuinely a change, which Dinsha can talk later. But broadly speaking, in a big picture sense, you have gone into the 30s kind of multiple and 28 multiple. But right now, they are viewed, rightly so, as having so much demand that you are worried about supply, that you are worried that we won't get enough engineers. So let them enjoy that for some time. And for consumer staples, we don't like the very high valuation companies anyway. And then we have now, because we have bought these state, we mean that's in the market. has got State Bank of India, then Tiscos and Hindalcos, that actually maybe the P's of our portfolios have come down. Because who had Tisco 2 years ago in his portfolio, 3 years ago? And so by bringing in Tata Steel or Hindalco or SBI, it has helped bring down valuations for us, and also in some sense. So it's okay. It's not the best ever time to invest on valuation, but it's not some edge of a cliff that suddenly will blow up tomorrow. But you're not going to get, as we said, everything perfect together. It is a long-term, ongoing thing of equities. In fact, in that presentation, when I was showing you the performance, if you see for the last 25 years, the average return of the market was some 13%. Okay. But if you look at plus minus 13%, let's say 2%. So how many years in 25 years did the market go up between 11% and 15%? So 2% less or more, because the average is 13. The answer is 0. Not even in 1 year has the market gone up between 11 and 15, but the average is 13. So the point is that is how the markets are, but it is not so bad, the valuation, that it's some end of this thing. It's okay. That's how it is. Life is like that.
So another question, is about that there is this thought that shorts have made more return for us. While I know the answer in the hindsight, I would want
they may have made, but it is irrelevant for today's conversation. First of all, they won't make so much more money because our shorts are 30-40% and our longs are 100%. Secondly, the market itself is up more than 600% during this period. So we have only shown you some of our good shorts. There are many shorts where you break even, you lose kind of thing. And overall, it helps in bringing down volatility. It helps in reducing beta. It helps in increasing alpha. But it doesn't make massive amounts of money except in very bad periods, like in 2011, 2013 and things like that. But overall, over a life where the market is up 600% and you are you're shorting stocks from that, some of them which were terminal cases, we had some of them. And some were regular stocks and you lost. But anyway, that is not today's conversation, beyond the point.
Coming to you, Dinshaw, there's a question while you did answer, or you did try and answer through the slides on one, that how do we manage the overall turnover in the portfolio? And second, when the panic hits the street, how do we manage, the drawdowns in terms of the portfolio, that how do we manage the stocks, and what is our thought process at that point of time when there is a panic on the street?
So Samir shared with you,
which is every year. Once every year.
Yeah, literally. Yes.
So Samir shared with you the two valuation parameters that we have. One is the reasonable, high confidence in reasonable returns, right? So that is the bread and butter of the portfolio. That will be, so what we try to do is we mix there. If we believe the market is volatile, you will see that the bulk of the money is lying in that portion of the portfolio. And that's why that portion provides you the stability. The bottom portion is where probably, during panicky times, probably there'll be 25% invested, but our analysts will be spending 75% of the time trying to track those stocks, because that's where the paranoia lies. These are the stocks which don't have much of history, where the analysts will be tracking on a regular basis. But these stocks also provide you a massive alpha during times of an up move. And that's where I think that is what we try to control in times of downturn. And so most of the realized profits that you would have seen would be in this part of the portfolio. Sorry, Samir.
No, same thing. So I was going to say that, normally you could have a PMS which says very high quality, very low sort of volatility. And that is one part. And then second part is where you're saying buy a mid-cap, turn around, new stories. So the idea here is that we want to do both the things in one fund, because for many investors who may buying only one PMS, they give up many of these, because over time you've seen that discovering new names is a massively value added exercise. And we have been doing that from Bharti to HDFC Bank. You saw in 2003 when we left Alliance, Kotak Bank was there when it had become a bank 2 months before only, and whatever. So, but if you do these in two different buckets, those are two different PMSs which currently are available in the world. We just want to do in one because we think that it is too unfair to the investor to say, you choose what you want. So that if it doesn't work like that, we say, you chose that. We want to do it because we want to be a core portfolio. But more practically, why we want to do that is that we are not dumb, that we can't do two things together in one fund. So we want to do everything in one fund as one offering.
Another question is about the disruptions which is there in the fintech through the fintech in the financial services, and also about the overall digital play. So your thoughts on that?
So we have some of these digital plays, but before that, on this fintech thing, the Kotak banks and HDFC Bank and all were defenders. Now they are defenders. Previously, they were the aggressive guys taking market share from, say, the PSUs or whatever. And in some sense, you can see that change in our portfolio also, because suddenly we have ICICI Bank and State Bank, where also in our portfolio in a meaningful way. And we have reduced the pure private guy lending to consumer as our big play because of fintech. But we are hoping that these guys will have ability to fight this for some time, and we'll see how it goes. But this is a volatile thing that can change if some fintechs are very successful. One angle is that the fintechs themselves are fighting so madly with each other, and in the end, they do need banks. So you saw Paytm sign up with HDFC Bank. And so in theory, HDFC Bank could say that we are treating Paytm as our front end, as a feet on the street, because they have people on the street getting them business. Instead of people on the street getting them business, Paytm guys getting them business. And whatever little they were sharing with their sales, not their own sales force, but third-party sales force, that plus minus a little bit they are giving to these fintechs. So fintechs also can't totally survive on their own. But yeah, these things have to be analyzed. And on the basis of this disruption game is why we don't own the multiplexes, and we mostly don't own auto. Mostly means we don't own any, and we are short many, and we don't own two-wheelers because they're getting disrupted by Ola. So the disruption theme is everywhere.
So another question is about the some of the sector valuations. Would you like to talk on that?
I mean, beyond the point, what is there to say in these things? That is the thing is that if you look at over time, the markets are going to go up. Average of 15% per annum, as told by everybody, based on difference between fixed income and equity returns over 100 years, or by GDP growth in nominal terms. You can always say that the numbers are a little higher because the interest rates are very low and stuff like that. But broadly, they are not super out of line. How to say that? Don't look at 1 year returns from funds. Look at 3 year returns. Please show me a fund which is up 30-35% per annum for 3 years. None of them. Because 2015 was a bad year. 2016 was a flat year. 2017 was a good year, but 2018 was a flat year. 2019 was some moderately up 10% kind of year. And 2020, if you look at I'm talking about calendar years, because I look at it from calendar year for our offshore fund. So 2020, the market was up maybe 20%. So if I look at it for the last 5-6 years, the returns will be maybe 14-15% kind of number if you took it over the whole period. Now you look at numbers from 2007 December, go back 2007, 6, 5, 4, 3, and see the massive returns at the market level. Look at 2000 March and go back, and the numbers are much higher. So it is because we are currently anchored to what happened 1 year ago, and 1 year ago was like a bottom. So Mr. Irani, who very confidently said his day one investor is up 91%, next year it won't be 91 annualized. It is because of perfect starting point that it is up so much. in the end, it becomes, analyzed numbers become less, maybe not for him, but generally the returns going forward are lower. They are in the 15-20% kind of range. And if somebody can beat that market by 4, 5, 6%, that's a massive value add.
And ultimately, valuations are a factor of interest rates. Also, if the interest rates are low, the valuations tend to be high because your best substitute for equity is debt, and if debt is low, then interest has. I mean, the P's have to be high, effectively. Sorry, Samir, you were saying something?
No. Now I've understood the question which Devi was asking, because this person Rahul is saying that substantial return in your fund come from shorting. No, they don't. They help us in reducing our beta. And you could see that if you saw the advisory that we had with the ICICI Pru, that market was up 90, we were up some 290 or whatever. That was pure long only. No, our long only. We are originally long only guys. The shorting is helping in some around bad times.
Another interesting question is around the new theme, which is the ESG theme. So your comments on that.
So I think currently the ESG guys have it easy, because currently the stocks that they don't like on ESG are the stocks which even without ESG, very few people would have bought. Very few people would have bought oil and gas stocks because of disruption, because of electrification, because of cars, blah, blah, blah. And very few people were anyway buying IPC kind of stocks. So I think right now the issue is the ESG guys say, oh, we are doing ESG. But the stocks that they don't buy are the stocks anybody would normally at least not buy or not buy as much. The true test of ESG would be if for an independent reason, suddenly the oil and gas stocks went up 100% or ITC went up 50%, then we will see what the ESG guys say. But right now it's a fad. We fortunately, because we don't buy mining stocks, mineral stocks, and all these stocks, we say, we are already ESG friendly because we never bought things which were totally hurting the environment. Now, in terms of governance, even we have changed. Now, Mr. Irani and his team ask, oh, how many women members are there on the board? And what are you doing with employees? That question is being asked. Now, that question may be asked not only because we believe in ESG, but we know that the market believes in ESG and we also better believe. That is the positive force of ESG, that if you start looking at where the flows will go, that the European guys who are mostly driving it are big investors in the world and in funds, that if they will not allow certain stocks to be bought, what is the point of we also should understand what they will not allow, and therefore everybody is going. But on paper, there is some of it on paper and some of it real. Right now, it is a mixture, because some fund managers believe that by saying it ESG 5 times, they might get some more money from investors.
So while I have so many questions, I will phrase this question in this way, that I have also never got an opportunity to ask you this question. I will ask this question. There has been in context of the EVs, right? In context of the EVs, there are talks that on the investment side also it will impact. Since you both come from 90s and you have seen the evaluation of the overall the Indian equity market, what's your take on the man versus machine, thesis which is coming in the investment side also, that the machine based buying and stock? What's your take on that?
So I would say that Dinshaw can have his view, because we have never discussed it so much at this point. But my view is that maybe machine plus man might work. Pure machine, I think, is not working so easily unless the model is the high frequency type, where you're effectively front running others. And those guys normally don't put it into funds because they don't want their trade secrets to be out. So they will do it prop, and they make a lot of money because they come 1 second before the next guy kind of thing. But that is not a model where you will be able to invest. Maybe they will take away some of everybody's returns, a few basis points, which for them add up. But for us will not matter so much because, okay, if you take 10 paisa more, okay, I know it's bad. And when you collect it from millions of people, you have made a lot of money. But I'll say, ठीक है भैया, तूने front run किया 5 पैसे ले ले kind of thing. So I don't think pure machine is coming. Why? Because I don't see the big guys in US, the Blackstone, or in India, the HDFCs or somebody who is not person dependent. Here you could say this team dependent. If this team has started company until we have hundreds of fund managers and hundreds of analysts, we are dependent on all of us. So we may say we don't have this history of doing machine based, but somebody could hire a new guy. We could also hire one day. But none of the big guys are presenting funds like that. Let somebody, not these renaissance kinds, which nobody knows what he does. He can do it for his prop money, but when he does it for institutional, it doesn't work. It has not worked at scale, and it has not worked widely. So we are okay. We are doing well. Unlike others, we don't have this problem that we have had long-term performance, but we don't have mid-term performance. Or we have mid-term, but our short-term is bad. No, all the three we are doing well. So we think men are also working okay. And some women also. But in our group, mostly men and a few women, unfortunately, so far.
And there was another question on that, why we don't take any exposure on international markets.
Oh, we don't take because PMS cannot take. Yeah. You guys should take. Yeah. International is good. We actually have an international fund, which is managed by a lady. But the point is, we can't take in a PMS. Otherwise, we would like to take 10, 20% in international stocks for sure. Yeah. There's one question I can read out here, which is talking about Helios getting approval for mutual fund business. Actually, Helios has not got approval. We have applied for approval. And as you see, these approvals take a lot of time. Just recently, Bajaj Finance which had applied at least 8 months before us. And then Zerodha has applied 1 year before us, hasn't got. These things take time. When we get, we will know what to do. Right now, we are answering the questions that they have.
Would you like to take a question on cryptos, or there's a question on crypto?
The crypto question is that there's a guy called John Paulson who made, he did the biggest trade ever, $20 billion he made in 2008. He personally made $4-5 billion. Today's interview has come, crypto is going to zero. So this is just to needle you guys. We don't believe in crypto because we believe in what we do.
And the only argument in that favor is that it is currency. It may be a future currency for reserves. And have you ever seen a dollar moving by 20% in a day or a 10% in a? No way. So there's no way it can be considered.
I had a book here. I wanted to show you guys. So I was reading a book on crypto. It's lying here somewhere, a crypto book. But it's very complicated. Okay, anyway, we don't know much about it.
So I think the last question which I would ask is, I think most of the questions we have answered.
Okay. So one question here is, what is the minimum? That is a SEBI rule. There's nothing we can do about it. It is 50 lakhs. NRIs can invest. Taxation, you have to, it's basically you have to deal with taxation in the sense that these are trades done in your name, in your account. And so effectively you'll have to pay taxes. That is why we are particular about trying to reduce the churn. And that's why Dinshaw showed you that it's only around 20% of that on which the tax is paid. And actually, if you look at it, we did this because this question everybody would ask between a mutual fund and a PMS or a whatever, that if you are assuming that the churn or the whole portfolio is rotated, say once in 2.5, 3 years, and in a mutual fund, after 5 years, you get sick of that fund and you sell it, and so you pay tax once, then the difference of tax is less than 0.5% per annum, assuming a 15% return. And therefore, you have to outperform by a little bit to overcome that. And we have basically, in our long short fund, beaten all the long only guys, where you're only playing with 60% net exposure. So we hope that we will compensate for that very easily, whatever tax has to be paid. Okay, one question, let me answer, Devi, because these questions I like to answer because people keep asking. So maybe you. So this question is about what you consider high valuation. So our view on high valuation is relative to history. In the sense, if you look at US consumer stocks, they are at say 20s, maybe it's one of them, few maybe 25, 30, but they are not 35, 40 valuation. And they were actually at 15 2 years ago. And the Indian companies have always been 30 to 40. And so we can't fight that over time saying, how can it be even US has actually lower interest rates than India? Why should Indian Ps be 30, 40? So chalo, theek hai, we don't want to fight because it's been there for 10 years and 20 years. What we fight are where the same company for highly ordinary earnings growth of 10, 12% are now trading at 70, 80 multiple. And we have sold so many of these over the years. We showed you two anyway. Basically because we want for stocks that are well known, which were well known when we bought them. Maybe Bajaj Finance was not, but Aishan generally was. But even if you look at the bigger names, because we had many of these D-Marts and Nestle's and all, that if the returns are coming not from earnings growth, but from higher and higher valuations for the same company, which was trading at a reasonably high valuation 2 years ago, that is what is, according to us, an easy out. Some you will get confused, oh, this company is doing better or worse, and you'll try and drag it if you have it. But there's no logic to buying companies where, valuation is the real this thing in terms of return.
There is one question on
will the ability to not short in PMS largely impact performance? Yeah, it will impact. It will make it higher mostly. As I said, the purpose of a short, if the market is rising, which is what over time they do, is that the short is being done to reduce volatility. The reason why we have done well is because we say, and we have shown you, that our long short fund has done better than long only funds and benchmarks, even after charging a performance fee. But that is not the typical model. If you see, you read the hedge fund guys in the US, the long short guys, our long short guys in Bombay, they don't outperform the index. They say we are a separate risk return, this thing. That if our net is 60, why are we to be compared with a 100% benchmark or a equity fund? Because we have done it and we have challenged the world and we say we will do it. That is what it is. It doesn't mean that is the normal thing that a long short fund will beat the long only benchmarks. It has not been done in the US except in some very hi-fi guys, and whatever luck shot, we have also done it. But that is not the standard model. So the long only should do in theory better, maybe a little bit more volatile than the long short. So, okay, the one question is, how come, can you elaborate on the tax differences with respect to mutual funds? How come so small? Is it not every time a transaction happens? No, because taxes are paid once a year effectively. So it is not that on every day you're paying because you might make a loss. So if you say that the return from a fund is 15%, let's say from the market or from the fund, let's say, the return is 15% and is also 15% in a mutual fund. And we are saying that we are going to hold stocks on average. I mean, we will churn the whole portfolio within say 2.5 years or 3 years. So that means on the 15% first year, you are paying because you're holding it beyond 1 year, which is the main goal. So we assume that we are selling some 25% before 1 year and 75% after 1 year. So you're effectively paying a tax of say 10 and 15, 12.5. So you're paying a tax of, and you're paying it on the 15% gain. So you're paying a tax about 1%. But the mutual fund is not going away. We are assuming that he's paying it after 5 years. If you say mutual fund, you will never sell. Yes, then the difference will be even higher. But the mutual fund guys don't outperform most of them. You have seen that because of their size and because of the scale, and we have in Helios days, in Alliance days, when we were not in Alliance days, we have beaten the market by 5-7% per annum after paying the management fee. Any options for foreign citizens to invest in India? They can invest in the offshore fund. You can invest in a long short fund if you are a foreigner not staying in India. At one time, you were bullish on RBL Bank. What happened? Life happened. That is what we are saying. There is life. Nothing is in hindsight. Everything is looking at forward. Do you think your experience goes against you in today's age? In today's age, we are up 90% in 1 year, so we don't think it is going anywhere. Okay, so one question is that we say we don't like high valuation. So how are we holding, or how did the world make on Amazon so much money, which by the way is our second largest holding there? We are not talking about companies that defined their category, that started an industry. You today can't go and say Zomato is high PE, so I'm not buying. You may say, I don't believe that it will sustain, that the growth will not happen, that there'll be too much competition, but there's no valuation in that sense. What we are talking about high PE is when the same company was trading at 25 multiple in 2010 and has become 70 multiple while growing at 10-15% per annum. So when we have a company like Dixon, which we bought very early and we still have, it is because now we expect that its earnings will grow like at 100% for 3 years. And then maybe it plateaus or stay. So therefore, these valuations in the very short term, we have still trimmed, but we have to let it go and we are not going to zero. But it is a very different game than saying a steady company, which everybody knew was high quality. Everybody knew was converting earnings to cash at whatever pace. Suddenly, somebody says now it should be valued at 80, 90 or whatever company. That is the point. Dinshaw, you can talk about pharma sector. What do you think about correction in pharma sector?
So basically the problem the sector arose because of some short-term issues in the US. The bidding process changed. There were one more additional bidder which has come in for the bulk products for insurance firms. And that has happened in a very short span of time. The guys who lost out in the first round of bidding went for the second round of they cut the prices to get into the second round of bidding. And that's what caused the upheaval. Our expectation is that even this quarter, there'll be some sort of a pressure on a YY basis. However, on a sequential basis, it'll be more or less flat. I mean, there is marginal pressure because some spillover happened. In the first quarter per se, again, the problem was that a lot of inventory came and hit the market when the wave 2 started, actually. Wave 3 started in the US. So that's why that inventory had to be liquidated over a very short period of time. So that's why we believe it's a shorter term issue. But having said that, you have to be very clear. You have to be only in those stocks, pharma stocks, which don't have a concentrated exposure to the US. They're very diversified in terms of the portfolio that they offer in the US. And that's why our offerings are, we are very selective in our holding here, and that's why we leave it at that pace. On a longer term basis, obviously, COVID has made the sector very attractive as when you look at the China plus one story, which is yet to play out in a big way. And as and when that happens, obviously the sector is looking very exciting from that point of view.
So one question here is, sorry,
if not MF, any plan for starting small case investing?
No, we will not do small case investing because we want to start MF and then there are too many different variations of this thing. So one question is on any stock that have not worked over the last 10 years. Well, because our main point is that we buy these newer names 2-3%. So many of them don't work because we were all trying to buy the new HDFC banks. So we bought RBL Bank and then we bought these MFIs, one or two of them. Bandhan Bank we bought long time ago. By the way, now we are short. But anyway, so at that time, there have been many stocks that have disappointed. The whole idea is that the cost of error should be small because your starting positions in new names. We have broadly never bought a 7% position in our life. Even if I look at it like that, then how come HDFC Bank is today 7? Because we are not saying that obviously in the new fund we started with 7, but if we take it as one continuous this thing for 25 years, we must have started with 2-3% and then it went up and we said we should not trim it. and then we kept it kind of thing. But we have never started a completely new name in 25 years with a 7% position or a 6% position. And I think most probably even a 5% position we have not done if you take it as a continuum. But obviously when we launched a new fund or we were doing a long only, when we had a long short, then in that long only we may have bought 5 because we already had it in our other fund. It's a different thing. And that is the whole point I keep saying, that when people say that, how can you have only 2% if the multi-bagger is there? Nobody knows it is a multi-bagger, least of all the management. So let me give you some favorite examples. So Steve Jobs, when he died in 2011, he had two basically stocks. 80% of his net worth was in shares of Walt Disney, and only 20% was in shares of Apple. Now, why didn't he know that in 2020, it will be a $2 trillion company, and therefore I should sell my Disney shares, which he had got for selling Pixar to Apple? He's not. Nobody has said that Steve Jobs didn't care about money, or that even if he wants to donate it away and he hasn't, he didn't sign the pledge, whatever. Look at Bill Gates, who has a family office called Cascade Investments, and maybe 100 people are working there. And we have learned recently after the divorce, I knew actually before because it's there everywhere, that in his 120, not the divorce, I'm talking about the investment, that in his $125 billion net worth, less than $20 billion were in shares of Microsoft. Why didn't his investment office say, hello, what are you doing? You hire us, give us salary, but don't sell Microsoft. Because Microsoft is the massive outperformer over the last 10 years, and he went and bought Canadian railway stocks or whatever. Because nobody knows, as we showed you, that how good it can become. It will become because of circumstances. It will not because that one management is there. You have seen good managements change their jobs and become bad managements. You saw this guy from Ashok Leyland come to Eicher and effectively left with 1 day's notice. You think it has to do with some discovering of my charitable interest or something, that you leave in 1 day because suddenly you remember that you have to do social work? So the point is, these things happen. What if some banker, let me not give his name because there are very few successful bankers, what if by luck that banker had an affair with his secretary and got fired from his job? I mean, this is luck, this is life. There is no such thing as knowing before. And we also don't know what is good management. Is it the Tata's management, or is it Tata TCS management? Because Tata Motors has been so poorly managed that in theory you should say that the corporate group has very poor capital allocation policies. Or is it that one guy who, when he changes his job, the whole story is over? Or is it the board whose names nobody knows? Have you ever heard of a board guy really coming out and saying, I made some change? This is all a matter. So if you don't believe me, read this book called Noise by Daniel Kahneman. He's a Nobel Prize winner. He wrote Thinking Fast and Slow. And he says that people who study the past forget about the fact that how much luck was involved in those groups doing well. If Mr. Irani and me had not worked together because I didn't like his mooch then, but I don't mind. But who knew before whether I would like it or not?
Would you like to answer? Question. There was another question on skill and luck. Would you like to answer that?
Yes, I would like to answer that, because the whole idea in a skill and luck is that if you read this book, Nassim Taleb's Fooled by Randomness, and also there is a book called Untangling Success or something. Basically, the point is, you cannot be lucky in writing a novel. Mostly. You can be lucky even in making a film. Sometime maybe the film is a hit, although it was a poor film, because it was so poor that people liked it. It was so bad that everybody says you must go and see how bad a movie can be, and it becomes a hit. But generally, you can't create a tune or a song or whatever by luck. But investment you can achieve by luck. So in the theory says that Warren Buffett in theory could be lucky because he's made only 30, 40 investments. Although they say for today it's at 400, but at least the book said when I read it. And therefore it's possible that he was lucky in few of them, whereas George Soros cannot be called lucky because he made hundreds of decisions. And so to be right on hundreds of decisions is more difficult. We believe that our model is not based on luck because our position size are only 3%. We have 35 stocks, and we are starting some positions with 1.5%. Actually, we even buy 1.25%. But normally we try to make it go towards 2 when we get some money from somewhere, some sale or some dividend or whatever. So the point is that why we believe that it is possible to do it with 30, 35 stocks is because we believe that there are 90 stocks that are going to do very well. So my 35 stocks, what I in theory can buy another 55 stocks. So if you see Mr. What's his name? Peter Lynch. Peter Lynch outperformed the market by I think 12% per annum for 12, 15 years. He used to own more than 150 stocks. My friend is not here. Maybe he's there, Safir Anand. He owns 100 stocks and sees performance. The point is there is no such thing. You have to reduce the role of luck. Like Shankar Sharma very brilliantly says that if there are if there are 2 batsmen and one batsman hits 250 runs and his average is 50, and the other guy also hits 250 runs over 5 innings and his average is 50, but one guy made 240 in one inning and 10 in the other 4, and the other guy made 40, 60, 50, 60, who is a better batsman and who's lucky? Because that day maybe the bat, or maybe make it longer, make it 10 innings so that it really looks lucky. And he maybe the catch was dropped, maybe the bowler was hurt, maybe he got some fluke, maybe some run out was missed. So consistency versus luck can be easily seen. If you are betting 5 times in your life, we don't believe you are skilled, you are lucky. Look at this guy, the guy who put $100,000 in Google. His name is Ram Shriram. He's currently worth $3 billion. Do you want to give money to him to manage? Because in 1998, he gave $100,000 by roaming around in Stanford and never did 1 rupee worth of useful thing after that. But he has made $3 billion. Who gives money to lucky guys? I would not give him because there is luck. Okay, anything else interesting?
I think the questions which we had got.
Can we get a copy of this presentation? The answer is no. Okay,
But
next
we'll be
question.
uploading the presentation on YouTube.
You can see this video as long as you want, but you're not getting the
you
presentation because it's a part of it is our offshore fund. We use it here, there. You will see it in various forms. We have to recycle it a few times.
There is one question from.
Okay, this one question I want to answer, Devi. The question is, since you looked at NSE 500 today, I like these philosophical questions. You looked at NSE 500 today, and then you said that these stocks went up, whatever, 500 times, whatever, the 32 stocks and all that. We totally agree. That is what we are saying, that the stocks of that time, these stocks were there at that time. Not all of them were small, because we can show you some of the stocks. It has Reliance in it, Nestle in it, not the 500 times, but more than 100 times. It has, obviously, many of the bigger names are also there. It's not only unknown names like Havells is there. Infosys was a very massive company, even in 96, relative to what was India's size. So the whole point is 90, 100 companies go up actually hundreds of them go up. The reason why people say that, what is the word is used? That wealth is created only in 20 companies is, let us say the market cap of Reliance is $180 billion and it goes up 10%. So now it has created $18 billion of shareholder wealth. Now some company which is at 3-4 billion, which is not small by anybody's standard, Piramal is $5 billion company. When it goes up, now only at that time it was, if it goes up some 70%, it's created $3 billion. Bullu, because Reliance has created 20 and TCS went up 10%, so it created another 16 billion. And therefore, in that sense, a very large company going up even 5-10% would create on paper more wealth. Well, we are not interested in that wealth. We are interested in the percentage return. And it is not possible. It is not arithmetically possible. But more than that, I've shown you actual data from the largest companies in the market, looking forward, not looking back. What I showed you from 96 was actual numbers, because I was showing that, while we were there in 96 and all. But for the the US and the Indian data, it was looking forward, starting with the constituents of the S&P 500, what they did in the next 1 year and 3 years. Because there are a large number of companies in the market, the average of that index will be a large number of companies divided by Mota Mati 2, because it will be somewhere at the half level. And therefore, a half the companies in the market will beat the market. It is arithmetic. It has nothing to do with anything else.
There's one more interesting question, which is around forecasting, which is that your views on assumptions taken. Does it really make sense to base decisions on presumed numbers? As Nassim Taleb calls this epistemic arrogance. So your views on that?
To be able to say, well, this thing is we still have to think a little bit whether it can't be totally blind. That's why we say our 8 factors are good. Use them as a veto thing. So for example, let's say the industry is fertilizer industry. And every morning the government says we are liberalizing and we are not liberalizing. We are not interested. So we have saved 10 companies that we don't want to research. Every morning they say we are analyzing and selling or not selling BPCL or oil companies, and whether these companies are truly independent or are they departments of the government of India, and therefore what should be the valuation. Let me give you my last one. After that, I think we should pack up. So look at Tata Motors and say what is the reason why Tata Motor DVR trades at a discount to Tata Motor, even though the Tata Motor DVR will all its life give you a higher dividend than the Tata Motor share. And the discount is 50% or more or whatever it was when I last saw it. So what is it that more that you're getting? Are you wanting to vote? What is it that you want from Tata Motor DVR that is sort of worse than what you're getting from the Tata Motor share? Is effectively your role. If it's a takeover, they may throw you out, they may not involve you in a strategic transaction, things like that. So in a PSU company, when you own a PSU company, do you have any vote? You have no vote because the government is the decider for you. So effectively what you own are not shares in these companies. You effectively own DVRs of these companies. So if you own DVRs of these companies, the DVR is supposed to trade at 50% discount to whatever otherwise the stock should be trading at. So when you see a company trading at 5p, maybe actually it is trading at 10. It is just that you are opening. I mean, there's no actual because that is the thing. But theoretically, you are owning the DVR, so you are paying half price for it. So it is not a cheap thing. So the point is, these things, there is no end to how to analyze, but we have our own way and we move on.
One last question before we back up is, there is a book tree behind you, just behind you, and there is a question also on that which one out of that or whatever you have read so far, which 2 books would you like to recommend to our participants?
So which I keep saying on everywhere, I just gave an interview to Economic ET Now, which will come in the next few days on books, because they are starting some book thing. But basically the best book I say is Fooled by Randomness. The other book you can read is The Halo Effect. These are simple. I mean, the first one is not very simple, but I'm talking about the market kind of guys, right? Yeah. If you've read these 2, then you go on Twitter and see under my likes, there are only book recommendations there. Okay, very good.
That's it. Thank you very much.
Thank you.
On behalf of participants, I would like to thank Samir and Dinshaw for the insightful discussion. And also I would like to thank all the participants who have encouraged us with the overwhelming response to our webinar. Really appreciate you taking out time and joining us. Thank you very much and look forward towards many more sessions. Thank you so much.